Imagine this, a chilling forecast where nearly 9 in 10 scenarios end in financial catastrophe for the US. This isn't a plot from a dystopian novel. It's the stark prediction from Bloomberg Economics, which has run 1 million simulations on the sustainability of the US debt outlook. And the results? A whopping 88% of these simulations predict a disastrous end if current trends persist. Let's delve into the heart of this fiscal conundrum. The Congressional Budget Office, or the CBO as it's commonly known, has been waving the red flag for a while, cautioning that the US is treading a path towards a debt-to-GDP ratio higher than the peak observed during World War II. But Bloomberg's analysis hints that the CBO's projections may be too rosy. The simulations signal that without significant reforms, the debt-to-GDP ratio could hit unsustainable levels within a mere decade, intensifying the nation's financial vulnerability. Now, the term unsustainable is bandied about quite often. But what does it really mean? In the realm of US federal debt, it points to a situation where the debt grows faster than the nation's economic output. This leads to an escalating cost to service the interest on that debt. If left unchecked, this scenario could spark a fiscal crisis. Currently, interest payments on the debt have crossed the $1 trillion mark annually, a figure that's predicted to skyrocket, further squeezing government finances. So how does one escape this looming debt trap? The report suggests 4 potential strategies. Outright default, which is highly unlikely since the US can print its own currency. Austerity or drastic cuts in government spending, which is politically tricky and economically harsh. Increased taxes, which could incite public discontent and might still fall short of covering the debt. And finally, monetizing the debt, where the government prints more money, a move that could trigger inflation. This last option seems the most probable. For investors, these projections should not be taken lightly. The scenario presents an asymmetric risk, where the potential for loss significantly outweighs the potential for gain unless one navigates the situation wisely. For those aiming to shield and grow their investments under these circumstances, diversifying into hard assets like gold and real estate, or scarce resources like Bitcoin and energy-intensive commodities such as oil, natural gas, and even uranium, is advisable. These assets usually maintain their value or even appreciate during times of inflation or economic uncertainty. To sum it up, while the Bloomberg report sketches a grim scenario, it also highlights the significance of preparedness and strategic financial planning. For investors, grasping the dynamics of debt and inflation and adjusting portfolios accordingly could not only ward off risks, but also seize potential opportunities in turbulent times. This approach is crucial as the US navigates what could be one of the most challenging fiscal periods in its history. And before we wrap up, don't forget to hit the like and subscribe button.